Yeah.
Welcome, everyone. Good morning or good afternoon. My name is Keith Duran, Senior Vice President of Business Development for Lear Investment Management, and welcome to the April edition of our strategy update webinar. We are joined, as always, with or by Jim Warner, the head of research and co-portfolio manager. I think there's a lot to chat about today. Jim and I were just talking before the meeting started about we have the Iran conflict and rising oil and interest rates. The market's pricing in maybe rate hikes, but if GDP, continues to fall, doesn't that, warrant for the lowering of rates? So there's a lot to cover. For those of you that are new to us, because we are getting so many new people joining us each month, Jim's going to talk for about 30 minutes or so, and then we're going to open it up for Q&A. We encourage questions, just ask away as he's going through his prepared remarks, the presentation. You can just click on the Q&A button at the bottom of the screen. Go ahead and ask your questions, and then we'll address those at the end. I think that covers all of the housekeeping items. So, Jim, I'll turn it over to you.
Great. Thanks, Keith. And thanks, everybody, for joining me today. All right. Yeah, we've got a lot to talk about. You know, the if you've been following along the last couple of months, you know that what we have done is we basically um, you know, did a pretty big rotation at the end of the year out of kind of the AI and electrification trade and into industrials, energy, and that sort of thing. And that has been that was very timely rebalancing or adjustment to portfolios. The other thing that we did and we talked about a lot in prior calls was that we raised the cash balances in these models and portfolios to pretty much their all-time highs. Around 20 to 25% of the models were put into cash, and they're still very heavy in cash. And part of what motivated us to do that was when that second carrier group started making its way over to the Middle East. So that was fortuitous, and so we've been able to mitigate a lot of the losses. And last time I talked about navigating the storm, and we talked about the Iran conflict, the threat that AI could pose to certain sectors, and we touched a little bit upon private credit situation that has grabbed headlines recently. So this is really part two of that, and obviously there was big news yesterday evening. This was actually, I wrote this presentation before the ceasefire was announced. But even at that point in time, I thought the question that we all need to ask ourselves as investors is it time to start looking ahead? And what I mean is to the end of this Iran conflict and to lower oil prices. And the answer, I think definitively now is yes. Of course, there's many questions as to whether or not this ceasefire is going to hold, but I think the intentions are certainly well known now on both sides. But as you know, March was a difficult month for a lot of investors. And us notwithstanding, although we mitigated a lot of it with our cash balances. And I just love the pictures that AI comes up with now. I think they're hilarious, but they get better and better over time. But many investors got very skittish in March, and obviously the biggest driver of this was the closure of the Strait of Hormuz. And this impassability it's really a short-term nuisance so long as it remains short-term. And there's obviously there were some ships that got through yesterday and the day before. There was one that got through today. Now there's this notion that Iran won't let any more ships pass because Israel bombed Hezbollah in Lebanon overnight. This stuff is going to work itself out, I believe. And it pretty much has to. There's too many there's too many countries and economies that are dependent upon this narrow strip of water. You've probably heard these statistics before, but just real quick, 20% of the world's crude oil and petroleum products go through there, 20% of the liquefied natural gas. By the way, most all of that comes out of Qatar. About 20% of Qatar's production is estimated to be offline for the next 5 years, given a recent missile strike. That's really great for our Cheniere position, which we'll talk about. 15 to 20% of urea, which is a key component of fertilizers, goes through there. We'll talk about all of these things in a little bit more detail. And then 25 to 30% of helium, which is used in semiconductor chips, is really important. And obviously, there is an impact to the US economy. However, it is much less than what it would be for other parts of the world, particularly Asia, which is much more dependent on these products that are going through the strait. But if we look at what the impact is to the US economy, so in crude oil, the United States is now the largest producer of oil in the world, even bigger than Saudi Arabia, by about 2 to 3 million barrels per day. Nevertheless, we still do import some crude, and about roughly 10% is coming out of that Hormuz region. So it's the specific type of crude that is needed in certain applications. So there's a little bit of impact. LNG, basically no impact. We're awash in natural gas in this country. We are the largest exporter in the world, and it's not really close. Cheniere Energy, which is a position that we have held in our portfolios since I think 2019, has just been an enormous winner throughout this Iranian conflict and the higher and the stress on energy prices. That continues to be one of our largest positions as well. And Cheniere in particular will be the big swing producer in the world going forward, particularly as this capacity in Qatar is offline. In terms of helium, it's a very low direct impact. The US is the world's largest producer of helium. 40 to 45% are the numbers that I found from the Department of Energy. Helium is obviously very important for semiconductor chip production, so it matters a lot more to Taiwan Semiconductor and the Samsung in Korea and some of the Japanese makers. That's a bigger deal for them initially, but obviously these chips are then put into products that are ultimately passed on to U.S. consumers and businesses. Urea and petrochemicals, again, we are a modest importer of urea, but we do have some sensitivity to surging global prices. So while the direct impacts are actually quite manageable, there are many indirect impacts that you can kind of just run through your minds. Obviously, higher fertilizer prices means generally lower corn production. That means higher corn prices. That means your Fritos cost more, and anything else that's made with corn, which is an awful lot of food products. Um, Higher crude prices ultimately can translate to higher diesel prices, therefore higher shipping costs, therefore higher goods prices, et cetera, et cetera, et cetera. So you can go down this path where if the Strait of Hormuz is closed for long enough, we will ultimately see some negative impacts and economic damage. Of course, the question is how long. And well, obviously the ceasefire provides some hope and some a little more, or I'd say a little less uncertainty. There's still a lot of uncertainty, but you know how prices go, how market prices go. The stock market will begin to anticipate that the strait will open up at some point, and it could be today, it could be tomorrow, it could be a week from now, it could be a month from now. But what this will do, I believe, is it will unleash more risk taking. You'll see a rally, and it won't just be in some of the more cyclical stocks that have been hit as a result of this, but it'll be the AI trade will go back on, the electrification trade will go back on. And this is a great picture that visually describes this sort of backup that the Strait of Hormuz is creating, and not just energy related names and cyclical names that use those energy products, but it's really backing up the whole market. And so unlocking this will essentially most likely lead to a broader market rally. It will also mean that commodity prices will start to head lower. And obviously, everybody knows that gas prices have shot up, pretty dramatically. Urea prices have shot up. You name it. You're seeing these big surges. You'll see that start to unwind. Even today, with this news. Oil's down, WTI crude is down about 15%. So, while it's still around 90 to $95, I think with reopening, obviously there are going to be some kinks in the reopening of that strait, as well as restarting oil production in places like Saudi Arabia. I think we can assume that, well, we won't probably return back to the $60 area of crude. We'll probably be in the 70s, maybe 80s, lower 80s. And that's fine. We can absorb that. So, and so one of the things that we took a look at was just how does gasoline prices impact consumer spending? And I think this is a really interesting table and a set of data. If you take the US consumer and you segment them by quintiles, and in this case, what we're doing is we're looking at the top 20%, which is basically people who make over $135,000 a year or more. They spend on average 1 to 1.5% of their annual income on gasoline. This is a survey that's done by the Bureau of Labor Statistics, where I'm getting all this data. This particular quintile comprises 40% of all consumer spending. And if you look down this column here with the estimated percentage spent on gasoline, you have to get down to kind of the fourth and fifth quintiles before gasoline is a really pretty material part of the income that is spent. And you also can notice that these last two quintiles, they only make up 20% of total consumer spending. So there's plenty of room for most consumers to absorb higher gasoline prices. Obviously, for the less fortunate, it's always going to any increase in gas prices they're going to feel the pinch. So hopefully, this obviously doesn't become something that really matters, and that the gasoline prices turn around. But it is interesting to see just how, frankly, insensitive the average US consumer is, and particularly those that really do dominate the consumer spending. So just to touch on, and I'm happy to answer any more questions that you have about Iran and the impacts, but I want to just touch on the AI threat that I went into some detail on last month. It's real. And to give you a sense, I just built I know how to code in Python, but I am not exact. Google's not knocking down my door to hire me. And I basically know my way around. That said, I just built with the help of Claude a portfolio management system. It has database, it has, a website that you can use, you can edit models, you can do all sorts of incredible things. It took me 2 weeks to do it. And that wasn't even like full, fully devoting my time to it. So if I can do that, somebody who's way better at coding and has a computer science degree, we can only imagine what they're going to create with AI, and particularly as AI becomes recursive over the next 5 years, 10 years, 15 years. And so when you stop and think about when you value any company, and in this chart here, this is the next 12 months price to earnings ratio of the software sector. And you can see that it's really collapsed. I mean, 5 years ago, names like Salesforce and ServiceNow are trading at 50 times earnings, and now they're trading at 20. And you say to yourself, well, that's cheap. Should we be buying it? And the reality is we just don't know what the terminal value risk is, right? Effectively, that's what a multiple is. We're essentially discounting back future earnings. And if we don't really know what the impact is going to be 5 or 10 years from now on their business, it's very hard to value it. And so it's we've avoided this sector pretty much entirely, in light of this, and so we really just don't know where the bottom is going to be in terms of valuations. I've heard some people argue that 15 times might be a more appropriate stopping place. So in other words, kind of price software companies where you'd price a typical financial or industrial company. But everybody's guessing right now. So it's just too hard to actually devote real capital to that. So let's just recap real quick where we are. So, we really don't have any edge on, when the Strait of Hormuz reopens, but this is clearly the gating item, right? This is what's driving oil prices. If oil prices go down, stocks will go up. It's pretty simple. You're seeing that today. And any hints of reopening, and again, I wrote this yesterday before the ceasefire, and that's a pretty strong hint of reopening. This market could rally pretty hard. And what you're seeing today is what you would normally see. We saw it after Liberation Day, and then the cancellation of the reciprocal tariffs, right? The first thing that happens is that all the shorts cover, and so you get this rip, and then the longs will start to come in, and at this point, what we're looking at, and we've been preparing for this moment, is to take all that excess cash we have and start buying back just really high quality businesses that have traded off pretty significantly, and that we can now buy at really attractive levels. In fact, for a lot of these companies, we're seeing valuation levels had returned all the way back to the depths of the Liberation Day tariffs announcements back almost exactly a year ago. So, we all know what happened after that, right? We had this huge rip into the rest of the year. So this, that could be the scenario here. So we're getting really prepared to deploy. Um, and that's because we're tactical investors. And, we even have started nibbling, bought a little bit of silver the other day, bought Eli Lilly the other day. So again, really high quality business, had traded back pretty significantly. This is the kind of opportunity set that we really like. As far as the AI disruption, we really don't know which businesses will be the most disrupted or the least disrupted. We obviously have a sense for which sectors are most at risk. Software is a clear example that we just went through. But some of these victims could be eventual winners. Take a company like Adobe. We don't have a position in it, but is it really going away through AI? I mean, are we going to get rid of PDFs? Or all their incredible design software that a lot of creative folks use on a daily basis. I mean, kind of hard to see how or why, but it is still too soon to tell, which means it's too soon to buy. And then one last thing I'll touch on is the private credit. You've probably seen in the news that there have been enormous amounts of redemption requests put in by investors, particularly into the BDCs and those interval funds. Remember last month I talked about those interval funds, how we really do not like them at all. We've gotten our clients out of it. We actually had a brand new client that we put in a redemption request. Remember, you only get 4 days out of the entire year to put in a redemption request, and we can only get half of this person's exposure out. So the gates are up. It's hard to get out. What was pitched as a too good to be true, low double digit, safe senior loan, trade is turned out to be exactly what it seemed like, which was too good to be true. So you're going to see, I don't think we're going to see any real contagion out of this, but you're going to see some pretty grumpy and unhappy investors that can't get their money out and don't like the marks when they actually finally get marked to market. So again, we're still, I'd say in a cautious state. We are ready to be optimistic. The ceasefire makes us a lot more optimistic, and I think you're going to see some, increased activity from us. But again, this could all change in a heartbeat. We know how this works, right? One tweet from President Trump or one, missile that flies in, from Iran and hits a ship, we could revisit new lows. So, being caught, this isn't we're not waving the green flag here to go risk on, but we're cautiously optimistic. Now, one of the more interesting things that's happened is that basically what the Iran conflict did was it meant, oil up, stocks down, interest rates up, and dollar up. And so previously in the Fed funds futures, there were two quarter point cuts priced in the back half of this year. Now there's zero. So there's this weird inflation narrative that has sort of caught the market. And it's this notion that if we have really high oil prices, we will have inflation. Well, I don't think that's actually exactly right. But nevertheless, that narrative sort of gripped the rates world, and you can see that the 2-year Treasury made a pretty sizable move from around 3.5 to about 4%. And so there's going to have to be some reshifting of expectations, I think, particularly if this ceasefire holds. You'll see rates come down. But just to hit on that point a little bit further on this notion of like, oh, high oil prices means we're going to have inflation, which means the Fed won't cut. Well, I would kindly, respectfully disagree because what will likely happen if you saw, $175 oil for long enough is you'd see GDP get crushed, right? You'd see demand destruction, and that's most certainly would lead to Fed rate cuts. So, again, I think this is kind of a worst case scenario that we're talking about, $175 oil. I don't think it's going to happen. I think, we're much more optimistic that about this ceasefire taking hold and seeing oil kind of return, to more normal levels. But, it's we have to keep in mind that, GDP ultimately is sensitive to whatever the outcomes are. So, but one of the good things that is evident, and again, this can all change, but one of the positive elements that supports consumer spending, supports GDP, is that American workers are getting paid more than inflation. So, basically, wage growth has been essentially pretty consistently around 4% year over year. Uh, how much more are workers getting paid than inflation has been hovering around this kind of, 1 to 2% range. And that's good. That basically means that there's a little bit of cushion for Americans to, deal with perhaps higher oil prices, higher gas prices. And if we then just sort of step back and sort of see, okay, where are we? It is the economy is still in relatively good shape. If you look at what the Fed is, focused on, payrolls and inflation, the ADP payrolls have been pretty consistently positive, for the last few months, really for almost a year. You've seen, and that's with, so ADP payrolls, remember, that's over 20 million actual payrolls that this company looks at, which I think is frankly probably a better statistical estimate than what we get from the government. But there's no government payrolls in this number, I'd point out. And so some of the weakness that we've seen in government payrolls would not be reflected in this number. But stripping that out, generally been pretty solid. And our favorite measure of inflation is put together by a company called Trueflation, which looks at millions of real-time data points. You can see that at 1.28%, which is where it is today, uh, inflation is well below the Fed's 2% target. So we feel still pretty confident that the inflation picture is going to be fine going forward, again, pending how long this particular situation with the Strait of Hormuz continues. So, real quick, let's do a performance update and then we will take questions. This is a graph of our four major strategies: our global vigilance, tilt, moderate, conservative, and strategic income. And then the red line is the S&P 500. What I did was I charted each composite's performance against the S&P here. Since the beginning of the year, you can see that all of our strategies are beating the S&P pretty handily. Um, so it's certainly been helpful that we were rotating into more attractive sectors, raising cash during this period of volatility. Now it's going to be our job to deploy that when the time comes. And I also wanted to remind folks that, kind of our approach as investors and not speculators, because, we get calls from time to time from people who are, particularly worried or don't understand how we're thinking about things. And so we want to make sure that people understand our approach. I used this slide actually about 2 years ago when we were going through another period of intrepidation. And because market pullbacks will reveal your true nature as either a speculator or an investor. And so I think it's just kind of helpful to define what each is. Now, we believe that we're investors, and rather than be governed by fear and greed, which a speculator would be, we're unemotional when it comes to assessing data and determining how much risk we want to take in portfolios and which themes do we want to be invested in, et cetera, et cetera. It's also a fact that speculators generally don't do any sort of fundamental analysis at all. They just chase sentiment. They're attracted to consensus ideas. If you turn on CNBC and you listen to all these talking heads talking their books, they talk like speculators. They don't really, man, most of them don't talk like investors. Investors understand the fundamentals. And our job is to uncover misunderstood firm value, not just jump on the bandwagon and hope everybody's right. That usually leads to pain in the end. We also have a longer term orientation and we're patient. And that's really important. That allows us to be much smarter about, in general, in when we get in and when we get out of things. All of that obviously takes discipline, which speculators lack. And ultimately, speculators become their own worst enemy. We are about, number one, protecting clients' irreplaceable wealth, and number two, growing it over the long term. So I think this is just kind of a fun way of characterizing how we think about the long term as opposed to just playing this, say this quick bounce. The other thing that I thought was interesting and about what's been going on year to date, I took a look at how we've performed or how we were the makeup of our portfolio, in this case, global vigilance, moderate, versus the S&P. And where essentially one source of outperformance was coming from was how different our sector allocations are versus the S&P 500. So if I put together this table here, and you can see that the best performing sector in the S&P 500 was energy, right? Not surprisingly. And it was up 38% as a group. It is only 4% of the S&P 500. So if you were to buy the SPYs, or if you were to invest like we see in client portfolios all the time, we see these firms put them in 150 stocks that basically replicate the S&P 500. 4% of them will be energy. In global vigilance, it's 13% of the allocation is to energy. That's a 225% overweight. Our materials, right? We've talked a lot about gold, copper, et cetera, uranium. That was the next best performing sector this past quarter, up 10%. That's only 2% of the S&P 500. It's 12% of global vigilance. That's a 500% overweighting. And then I mentioned before how we had done this, pretty sizable rebalance away from technology, information technology, which is 32% of the S&P 500. It was down 9% during the quarter. It's only 10% of global vigilance. So a huge underweighting in technology right now. We had basically virtually no exposure to the other two really poorly performing sectors, consumer discretionary and financials. That makes up combined, 21% of the index. So, a lot of people have gotten burned there this year. There was this huge move to try to chase financials into this year, and that proved to be a pretty unprofitable strategy. So, that's another place that we generate this outperformance. Real quickly, global vigilance moderate's up about 3%. It'll be up more after today. 10% net after fees annualized. I mean, this is a pretty remarkable performance. This means that we didn't just get hot, from time to time. We have a process that is repeatable, and that's how we generate really consistent returns. Tilt are aggressive, pretty much all equity strategy generally, except you can see it from the pie chart. We're pretty conservative, with a 20% allocation to cash and short-term fixed income. But generally speaking, this is a pretty aggressive strategy, and you can see that year to date, it's up. It's about to hit its 3-year birthday in about 4 days, which will be exciting. And it's up, frankly, 50% over the course of the last year. Our conservative strategy is doing even better this year. It's up 3.6%, 3.2% net of fees. Again, this one too has a great compounding of about 8% annualized over the last decade. So, this is particularly good strategy for conservative investors. And then another conservative oriented strategy is strategic income, which many of you on this call may not even have access to based on the platform that you access our products. But it's really supposed to be a proxy for essentially high yield like returns, but not taking as much credit risk as you would if you owned high yield. So we do that in a couple of interesting ways. So just lastly, I'll finish on this and I'll take questions. Really the themes in our portfolio have not changed that much. Um, I think as we start to kind of deploy the excess cash in the portfolios, they will probably go right back into a lot of these names, a lot of these themes. And yeah, so I'll leave it there, Keith, and let's take some questions.
Great. Thank you, Jim. Yeah, we do have a couple of questions. The first one says, what is the effect of France moving all of their gold out of the United States?
Well, it really doesn't have any effect other than just simply, shifting custody, but I don't see it having really any material impact on the dollar or the economy or even frankly on gold prices. So, yeah, I don't really find that a particularly relevant issue for our investment purposes.
Yep. Okay. The second one is interesting. So what do you think about the coming SpaceX IPO? And is this going to launch a whole new industry centered around space? But I would also even add, does that create maybe a separate theme for Lear Investment Management?
Well, yeah, I mean, it's really fascinating. If you look at what SpaceX really is, um, I'm going to answer this two different ways. What does it mean for the market, and what does it mean, in terms of, kind of innovation in general? And what's really phenomenal, right? SpaceX now contains uh, XAI. It also has, their rocket launching business, of course, and they make a lot of money, sending satellites up. It is a very interesting business. And if you stop to think about like what Elon's ultimate goal is he wants to put data centers in space. And he has the communication. Oh, also part of SpaceX is Starlink, right? So he is effectively, this business has essentially a whole other internet and communication capability that is extraterrestrial as it stands today. And it's fascinating at where this is going to go. I mean, if you guys don't already, you should listen to podcast like All In or Moonshots. I mean, they just did a really interesting, All In just did a really interesting conversation or podcast on SpaceX last week. You should look it up and listen to it if you're interested. But it's a fascinating business, and I think also there's a pretty high likelihood that eventually Tesla will become part of it. And if you think about the direction Tesla is going, again, AI, but more on the physical AI sense, and building robots. And now your brain can go bananas and you can start thinking about robots, SpaceX sending robots to mine for, important minerals on the moon. I mean, it's pretty remarkable. The innovation is incredible. And there is a really, really big burgeoning number of startups that are focused on space as an industry. So it's a great question. It is happening, and it's just going to become that much more obvious, I think, to the average person when this IPO comes through. The other thing I would mention is that there's a string of really, really big IPOs that are going to come to market in the back half of this year. So Anthropic is likely to come, OpenAI is likely to come. These are maybe Perplexity. Um, these are going to be some of the biggest IPOs that we have ever seen. And we are taking some time to consider what is that going to mean for freeing up capital for how are investors going to buy these things? The SpaceX IPO, for example, is estimated to be a $75 billion raise, the largest ever. And with something like a $2 trillion valuation or some craziness, where's that 75 billion going to come from? Like, are they going to take it from are they going to take it from Meta? Meta stock. They're going to sell their Meta stock to pay for that. Are they going to sell their Amazon or their Google stock? I mean, it's really not clear, but we're spending some time trying to think about that because it is pretty remarkable how much money is going to get raised, broadly speaking, in the IPO space.
Regardless of what you think about Elon, I don't think I've ever seen somebody that actually thinks that far outside the box. There are two more questions. So when we refer to a percentage of allocation to cash, what are we including in that allocation? Cash, fixed income, and short term, or other stuff? But just what makes up our
The
cash?
total account value.
Uh,
So if it's 10% cash, it's 10% of the total
no.
account
Yeah,
value.
what makes up? What do we call cash? What do we consider cash? I think is what they're asking.
Well,
Like
so in
Bill?
this particular case, I would say the actual cash, any money markets that are in the account, and generally we also consider any holdings in BIL, which is the short-term treasury ETF. We generally sum those three things together when we refer to cash.
Right. Very good. Super. Last question seems to be, so what are your thoughts on the U.S. shipbuilding and rare earth mining?
Well, yeah, there's been a lot of talk about both things, and on the shipbuilding side, there's a huge, huge push by the administration to build more ships here. There has been some discussion with the Korean shipbuilding industry to maybe build ships here for us. But it's all part of this, build it in America push. And, we really have very poor shipbuilding capabilities. And then as you start to think from a national security standpoint and look at China's shipbuilding capabilities relative to ours, it's pretty stark. So yeah, there's a big push there. We frankly just don't have enough capacity, and so there'll be a lot. I think we'll hear more about that, going forward. It's actually a really hard space to play publicly, for a variety of reasons, but yeah, it's an interesting point. It's definitely an area of growth for the economy. On rare earth mining, I think what the world has finally realized, because we've been involved with MP materials before. We know the space real well. I have a buddy who's building a rare earth processing plant in India right now. Um, what the world is realizing is that rare earths are not rare. It's rare earth processing that is rare, and that's where China's got 95% market share, and so there's clearly a huge push by the government, right? You saw them invest in MP materials directly to help speed this along. You're seeing, more activity globally. I just mentioned my buddy in India. So yes, there is a very decidedly political push and national security reasons behind it to increase the rare earth processing. That, by the way, is also part of the whole reason why Trump went after Greenland. The idea in Greenland is to basically build a lot of these rare earth processing plants there because it's so uninhabited. So, I think that's another really interesting, sector. We're watching it very carefully. There's a couple of interesting ways to play it, none that I think are really truly appropriate for our particular models, but yeah, it's a very interesting theme, and I'm glad you brought it up.
Good. Thank you. That seems to be all the questions. My last comments before we go would be one, to thank everybody for your time today and for joining us. Also, that if you need anything or help with anything, please feel free to reach out. We'll also send this, once it's been through compliance, the presentation live webinar along with the slides out to anybody who'd like to have them. Without, I guess, further ado, again, thank you for your time, and we will see you next month.
Thanks, everyone.